Inventory is the lifeblood of any business that sells physical products. Imagine a world where your favorite items are always available, where you never have to wait for that must-have gadget or that delicious snack. But behind that seamless experience lies the intricate world of inventory management. It's not just about having things on a shelf, it's about understanding how to balance supply and demand, ensuring that products flow smoothly from production to the customer's hands. So, what exactly is inventory? At its core, inventory encompasses all the goods a company holds for sale or production. This can range from raw materials, like the steel a car manufacturer uses, to finished products, such as the cars themselves sitting on the lot, ready for eager buyers. It's all recorded on the company's balance sheet, reflecting a significant investment of both time and money. Managing inventory effectively is critical. Picture a bakery that runs out of flour during a busy weekend. The smell of fresh bread wafts through the air, but there's no way to bake without that essential ingredient. Customers leave empty-handed, and potential sales vanish. On the flip side, consider a clothing retailer that overestimates its stock needs and ends up with racks full of unsold winter coats in the middle of summer. Capital is tied up in those unsold items, resources that could have been invested elsewhere. Finding the right balance is like walking a tightrope. Too little inventory can lead to stockouts, disappointing customers, and losing sales. Too much can drain cash flow and create storage headaches. The goal is to have just enough to meet customer demand without overcommitting resources. This isn't just a theoretical exercise, it's a day-to-day reality for businesses of all sizes. To achieve this balance, businesses must engage in careful inventory management. Regularly reviewing inventory levels is essential. Think of it as a health checkup for your stock. Are you keeping pace with sales trends? Are there items that are gathering dust? Investing in inventory management software can be a game changer, providing real-time insights into stock levels and helping to forecast future needs. Shortening production cycles can also help. If a company can produce and deliver goods more quickly, it can respond to customer demands without overstocking. And negotiating longer payment terms with suppliers can ease cash flow, allowing businesses to invest in inventory without immediate financial strain. Understanding your customer base is crucial. What do they want? When do they want it? By analyzing buying habits, businesses can make informed decisions about how much inventory to keep on hand. This isn't just about numbers, it's about creating a relationship with your customers, anticipating their needs, and delivering on promises. Now, let's dive into the different types of inventory. There are 13 main categories, each serving a unique purpose. First up, we have raw materials. These are the essential ingredients that go into creating a product. For example, a bakery needs flour, sugar, and eggs. Without these, there's no cake, no bread, no pastries. Next, we have components. These are the smaller parts that come together to create a finished product. Think of a computer manufacturer. They need processors, memory chips, and circuit boards. Each component plays a vital role in the final product. Then there's work in progress, or WIP. This is the inventory that's in the process of being manufactured. It includes raw materials, labor, and overhead costs. For instance, in a car factory, the cars being assembled on the line are considered work in progress. Finished goods are the products that are ready for sale. This inventory is crucial because it directly impacts cash flow. The quicker a company can sell its finished goods, the faster it can reinvest that money back into the business. Maintenance, repair, and operations goods, or MRO, are another type of inventory. These items aren't directly involved in production, but are essential for keeping the business running smoothly. Think of a restaurant. They need cleaning supplies, utensils, and other materials to operate effectively. Packing and packaging materials are also important. Every product needs to be packaged appropriately to protect it during transport and to make it appealing to customers. This includes everything from the box a product comes into the labels that provide important information. Safety stock is another inventory type. This is the extra inventory a company keeps on hand to account for unexpected demand or supply chain disruptions. Imagine a veterinarian who stocks up on pet supplies before a holiday weekend. If a storm hits and delivery trucks can't get through, she'll still be able to care for her furry patients. Anticipation stock is similar, but focuses on future demand. For example, an event planner might stock up on decorations ahead of the busy wedding season. By anticipating customer needs, businesses can avoid costly last-minute orders. Decoupling inventory is a bit more technical. It refers to the extra items kept at each production line station to prevent work stoppages. If one part of the manufacturing process slows down, having extra inventory on hand can keep the entire operation running smoothly. Cycle inventory is all about efficiency. Businesses often order in large batches to meet customer demand while minimizing storage costs. However, this requires a keen understanding of sales trends to avoid overstocking. Service inventory is particularly relevant for businesses that provide services rather than products. This inventory helps managers plan for staffing needs and anticipate customer demand. For instance, a hotel needs to know how many rooms it can offer during peak seasons. Transit inventory, or pipeline inventory, includes stock that's in transit between locations. This can take time, and businesses need to account for it to avoid delays in fulfilling customer orders. Theoretical inventory is a concept often used in production and food industries. It refers to the minimum amount of stock needed to ensure that production processes run smoothly without delays. Finally, we have excess inventory. This is the unsold or unused goods that a company doesn't expect to sell. It can tie up cash and take up valuable space. Businesses must manage this carefully to avoid losses. Now, let's look at some real-world examples. Take a grocery store, for instance. It operates on a perishable goods model where items have a limited shelf life. The store must manage inventory meticulously to avoid waste and ensure that customers find fresh produce every time they visit. On the other hand, a computer manufacturer might adopt a just-in-time model, where components are ordered as needed to minimize storage costs. This requires precise forecasting and a deep understanding of customer demand. Consider a t-shirt manufacturer. They need to manage raw materials like fabric and thread, but they also need to consider the finished goods, the shirts ready for sale. Every aspect of inventory affects their bottom line. A jewelry manufacturer packages charm necklaces, factoring in the cost of materials and labor to determine the cost of goods sold. This careful accounting ensures profitability while keeping customers happy with attractive packaging. In the world of WIP, think of a cell phone manufacturer assembling devices from individual components. Each step in the process is crucial to ensuring that the final product meets quality standards. MRO inventory is vital for a condominium community, which requires various supplies to maintain its buildings and common areas. By keeping a close eye on MRO inventory, the community can ensure that everything runs smoothly. Packing materials are essential for a seed company, where sealed bags protect the seeds during transport. This attention to detail ensures that products arrive in perfect condition. Safety stock is a lifesaver for a local veterinarian who prepares for potential supply chain disruptions. By stocking up on essential items, she ensures that she can continue to care for pets, even in emergencies. An event planner who anticipates demand for wedding supplies can stock up on materials ahead of time, ensuring a successful season. This proactive approach keeps customers satisfied and business thriving. Decouple inventory is crucial for a busy bakery, where decorators can keep extra sugar roses on hand to avoid delays in cake production. This small detail makes a significant difference in the final product. Cycle inventory is exemplified by a restaurant that carefully manages its supply of paper napkins. By ordering just in time, they can ensure that they never run out and always provide a clean dining experience. Theoretical inventory costs can impact a restaurant's bottom line. By minimizing waste and spoilage, they can keep food costs in check while maintaining high-quality dishes. Excess inventory, like a shampoo company left with unsold Olympic-themed bottles, serves as a cautionary tale. It highlights the importance of careful planning and production strategies to avoid costly mistakes. In conclusion, inventory management is a complex but essential part of running a successful business. It's about more than just keeping track of stock. It's about understanding your customers, anticipating their needs, and making informed decisions that drive profitability. By mastering the different types of inventory and implementing effective management strategies, businesses can thrive in today's competitive marketplace. So, whether you're a small business owner or part of a large corporation, remember, effective inventory management is key to unlocking your full potential.